Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And we're just going to do another review of Velocity Banking. So, just to start off, let's read this article from the Indy 100. Broke nurse begs for change after admitting she lives paycheck to paycheck. And then a mother of two has gone viral after breaking down in tears in emotional TikTok, which saw her share details of her financial hardship. The woman is a critical care nurse while also studying for a PhD. She and her husband live paycheck to paycheck despite both working full time. As she explained in the clip, the pair are left with only a few $100s after paying all of their bills despite both of their salaries. Right? They don't spend excessively but are still left struggling to reach payday every month after mortgage payments and bills had come out of their account. Right? So for a lot of people, this is just really unbelievable, right? Like, how do you make more than, let's say, $200,000 a year and still be broke? And once you understand who the bank's best customers are, or the most ideal customers, it's not like people who don't make a lot of money. It's people who make a lot of money but are kind of bad at managing it, right? Just like Big Pharma. Who's Big Pharma's best customer? It's not someone who's going to die tomorrow. And it's not someone who's going to be super responsible with their finances. It's people who are kind of like, oh, actually pretty healthy, but kind of bad at managing their health, right? So we really have to keep that in mind. And if I were really, really smart, I would have called this channel like Velocity Bank for nurses. So I could just market to them because they got a lot of money. But then there's a lot of broke nurses. And how do I know there's a lot of broke nurses? Well, I go on YouTube. Nurses are broke. 415,000 views. So it seems like it's a thing, right? So I don't mean to laugh at that. It's just like it's really surprising. Like, wow, these people who are making a lot of money are broke. And a lot of people think, oh my goodness, if I just made more money, that would solve my problems. Would it really? If you don't know how to manage your cash flow? Also, I heard that nurses, as a rite of passage, get BBLs and Mercedes. And that's probably one reason why it might contribute to their spending problem. I'll say it at that way. But yeah, let's go ahead and do velocity banking, and let me go to the other spreadsheet that we always do, right? So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account, right? Line of credit, debt payoff strategy. And so this is the exact same scenario that I did the other day, but I just want to do it again because I find it so fascinating, right? You make $240,000 of income. It could be one or two person. I don't know. I'm pretty sure that $240,000, that's probably a doctor's salary, but I've heard nurses making that before. Again, I'm not in the medical field, so I don't know what like salaries are common or if it's just something that yet you get after working 30 years. But let's say we make 240,000, right? After all of our expenses, we can get 1,400. So we feel like, man, this is not enough to save and live on. And we always hear, from wisdom of personal finance about how we got to have 3 to 6 months of savings of expenses. How much is 3 to 6 months of this? This is like 36 grand. So obviously, when we hear that personal wisdom or personal finance wisdom of you got to save 3 to 6 months of your expenses, and you look at this that we're only saving 1,400 a month, it's going to cause a huge anxiety. But here's what we're going to do, and here's what's going to be crazy: we're not going to save any money at all. No savings when we do velocity banking, right? So there's two requirements to doing velocity banking. Number one is the budget. Number two is the line of credit. Have a line of credit as your main operating account. Now, when you get a line of credit, and I actually closed on a line of credit today, I signed all the paperwork, and one thing you have to be aware is that if you're in this position or state where you got no money and you think you're going to get a line of credit um, at this stage of your life, most banks, like 98% of them, will tell you no. And the reason why is because banks don't lend money to people who need it, right? So even though you're making good income, but because your savings is dwindling and you got a lot of expenses because of all your debts, they're not going to lend you a line of credit because banks don't lend money to people who need it, right? So here's the line of credit that I closed on today. This $280,000. I know the secret, and here's the thing: I don't know all the technical details of what credit bureaus they look at, what the debt to credit ratio or debt to income ratio they look at. But I just know deep down inside, if I need it, I'm never going to apply for it. And that's how I got this $280,000 line of credit. So what is a line of credit? All it is a financial tool where you can borrow money, pay it back, and then use it over and over again. So if you have a credit card, that's a line of credit. If you have a HELOC, home equity line of credit, that's a line of credit, right? $280,000. So think of it as a huge credit card based on the value of your home, right? So we're just going to pretend that we do have a home equity line of credit available. And a lot of times when people have HELOCs or um, other types of lines of credit that they actually took out a long time ago, what happens is that, oh wait, I'm in the wrong one. What happens is that because they have so many payments, right? Like they quote segregate their income rather than putting all of their income in one place. Because they do that, they end up having a minimal amount of savings. Okay, and what we're gonna do is we're gonna have zero savings in order to maximize something called cash flow. Okay, and so as I'm doing this is like just unbelievable how someone with this much income can only does not have 3 to 6 months of savings. That would be the shame you would feel if you didn't know the strategy, right? But here's what we're going to do. Okay, let's just assume that we have a line of credit available to us, and believe it or not, that $280,000 line of credit I showed you, it's actually 8%. My previous line of credit was like around 10, 11. So I know I'm going to be saving a little bit of money here. I'm really excited about that. Well, but not really. Anyways, so let's go ahead and move these credit cards. So there's these 5 credit cards here. And how much is that? That's 5 plus 8 plus 15 plus 27 plus 30. And it's going to be $85,000, right? So we sum this up, it's $85,000. And what's really important when you do this strategy is you understand something called the debt payoff order, right? So if you want to know a secret cheat code of or a secret hack that you want to know, figure out like how do I know which debts to pay off first? It's always usually the credit cards and the short-term buy now pay later loans, right? So let's go ahead and move this $85,000 into the home equity line of credit. Okay, so we did that, and now here's the other thing too. Well, people don't understand the last part because they just, all right, you just shuffle debt. Okay? Yes. But after shuffling debt, what happens to this cash flow number, right? Well, these all go to zero. And now we went from $1,400 of savings to $4,295 of cash flow, right? And then now, because we've optimized our cash flow, then we're going to do the velocity banking strategy, or the final part, which is paycheck into the line of credit. And it doesn't mean you do a direct deposit, right? It just means you overpay. So if your minimum payment is like 500, instead of making the 500, make the 13,500. So whether you get paid weekly, bi-weekly, or daily, like maybe you're Uber or Lyft driver, you just dump all of your money into the line of credit and then take your expenses out. Okay? And so paycheck into the line of credit and then expenses out of the line of credit, right? And I probably need to go more detail just about the expenses, but I would use a combination of both credit cards and a line of credit because there's differences between those. But just assume for now we're taking the expenses out of line of credit, and then after every single month, the cash flow is essentially the amount that the debt on your line of credit will be reduced. Okay, so this is how we do the calculations. So to get the next month's balance, the previous month's balance plus the previous month's interest minus whatever our cash flow number is. So let's go here. That'll be 4295.74, right? And then you take the interest. So let's go ahead and take the interest somewhere by calculating with this average function. You take the average daily balance. So average, right? Like it's 82 grand. Is that crazy? That's an estimate of the average daily balance. Then you got to multiply by the interest rate. So multiply it by 0.085, right? That's the interest rate. And so you might be thinking, oh my goodness, 8.5% is 7 grand. Well, it's 8.5 annual, but they calculate it monthly. Okay, so you got to divide it by 12 to calculate it monthly. And then what we do is just copy and paste. So copy and paste, copy and paste. And then after 22 months, right? 22 months, then we good. 22 months and we're good. So 22 months, it's all paid off. The 85K, 22 months, 88K or 85K, right? All paid off. And then we write that to keep track of our milestones. And so we're doing really good. Now it's time, okay? Now it's time to pay off the auto loan, student loan, personal loan, mortgage. And we have these fixed expenses, but we make sure that we always keep paying up every single month. We're not trying to reduce our lifestyle. What we're trying to do is reduce the debt. And when we pay off debt, then we increase our cash flow. So let me just quickly check if the loan calculator is set up. All right, I think it is set up right here. So I have this loan calculator here where if you type in the original balance, the interest rate, and the loan term, it will auto spit a payment amount as well as you can determine what the latest or current balance is. So if like 2 months have passed, then you could see like what the balance of the loan is. So right here, I think how long was it? 22 months? 22 months. 22, 22, 22, 22. So after 22 months, okay, we see that the balances of these loans have decreased, but which one do we pay off? Because we have four of them. Do we focus on the mortgage first because it's the biggest balance? I don't know. Do we focus on the personal loan first because it has the highest interest rate, or maybe the auto loan or the student loan? I don't know. Which one do you think we should pay off, right? And we got this huge $200,000 student loan because that's the price of being a nurse, right? I think it is 8%, 10 years. So it's not bad. So here's gonna be the quote secret trick to know which loans you pay off. I use something called the cash flow index. Now I didn't create this, right? Created by Garrett Gunderson, but all it is a formula of the balance divided by the payment. And the lower the number, that's the ones you want to pay off. So as a general rule, anything under 50 is okay to pay off in your line of credit as a general rule. So you see 34 and 29 right here. This is going to be the personal loan with that high interest rate, 17%, as well as the auto loan, right? So let's go ahead and pay that off. And what we're going to do is combine these two balances here. Okay, and then we're just going to add G7 plus G8, right? That's 44 grand. And okay, so now let's go ahead and add 44 grand here. Okay, so now we move that 44 grand into the line of credit, 44693.86, right? And then guess what happens simply by moving these two debts into the line of credit? The personal loan and the auto loan. So we got the auto loan here, we got the personal loan here, and then this goes to zero, and then this goes to zero, and then wow, our cash flow is over $5,000 now in 22 months, right? Less than 2 years, we went from 1,400 to 5,600, and it was so easy that I didn't have to think about it, right? So let's go ahead and do this right here, and this is our new cash flow number, right? And so now, after every single month, the balance doesn't go down by 42.95, it goes down by 5673.27, right? And then let me go ahead and copy and paste. And then I'm going to, yes, we're going to do that. Okay. Whoa. Okay. So now we see that in 30 months, those two loans were paid off, right? So 30 minus 22 is 8 months. So 8 months we paid off those two loans. Okay. So how long? So this is 30 months. And how much was it? That's 85 plus 45 plus 20. So we paid off 150K in less than uh, 3 years. Okay. And then now we only have these two left, the student loan and the mortgage, right? The student loan and the mortgage. So he's like, well, do I focus on the mortgage or do I focus on the student loan? So as a general rule, you always focus on the mortgage last if you just look at it in terms of cash flow, right? Because in order to get this $2,400 of cash flow back, I paid $200,000, but in order to get this $2,100 of cash flow back, I have to pay $510,000. So I got to pay so much more to get less cash flow between these two loans, right? Isn't that crazy? So let me just kind of go here, and then now we're going to update our figures. So this is 30, and then this is 30, right? And you can see this cash flow index is very high. And as a general rule, if it's very high, that's the one you want to pay off last. You definitely want to pay it off, but you just want to pay it off last. Okay. So now let's focus on this student, or is it student loan? No, what is it? It's, yeah, student loan, nursing. So let's talk about how we can get rid of it. I think we can move it to the line of credit. I'll be honest, when it comes to like high balance loans, and if first of all, we got to pay off the other loans first to increase their cash flow. But when it comes to these very high balance, like student loan, law loan, mortgage loans, it's best to, in my opinion, use the chunking method, right? So just move a piece of the loan, so it's something like amount similar to your paycheck. And as a nurse or a medical professional, how much are we making? 13,500. So let's move like 1,400 or 14,000 into the loan, right? So let me just do this. So 163 minus 14. That's about 149,000. Okay. So let's move 14,000 into that line of credit. Okay. 14,000 plus 14000. Now, our cash flow didn't increase because we didn't pay off the loan, but look how long it took to pay out that 14,000. 1, 2, about 3 months, okay? Now, if I take a look at this loan calculator, it might be easier to visualize if we have a chart, like one of those charts on the internet. In fact, let me put one up. There we go. We got an amortization calculator right there. And so what we're trying to do is figure out how long, if we just look at the loan amortization schedule, will it take to pay off 14 grand, right? And let's just take a look here. So you see, this is year one, right? So year one is about 13 grand. And then year two, we pay off 14 grand. So we did it in a couple of months, but according to this, and hopefully I'm taking a look at this correctly. Yeah. So it's going to take us about a year to pay off 14 grand, and we did it about 3-4 months, right? Hopefully I'm looking this right. Yeah. So, and then if we just kind of do it again, then let's say, let me go back to my other spreadsheet right here. So if we do it again, so 1, 2, 3, and then we'll put in another 14, 14000, right? 1, 2. So it's going to be, so it's about 5 months to pay off what would have normally taken us about 2 years. Isn't that pretty amazing? So we just rinse and repeat over and over again, and then now this would be the time where I would take out that velocity banking calculator because it's a little bit complicated to calculate this accurately with huge amortized loans, right? So let me go ahead and pull that up. So give me 1 second, and then I'll just pull it up and then put that calculator in. All right, there we go. You just fill in the numbers. I kind of already did that here in this calculator where you have the original balance, current balance, interest rate. And look at this. We paid off our 10-year loan a little bit under 2 years, right? So there wasn't that much interest that we paid on the loan. So we're going to pay about 54 grand, and now we only pay 12, right? So pretty good. And so income is 13,500, expenses is our general expenses plus the mortgage, and then now our additional payment for that student loan is included here. And so we see it takes us 1.9 years. So now let's record that into our other spreadsheet. And now we go here, and then, so this is going to be 30 divided by 12 plus 1.9. How much is that? 4.4 years. Ooh, 4.4 years, and we're credit card, auto loan, personal loan, and student loan free. That's amazing. All right, so 200, so 350K. Okay. Now this is zero, right? So what's our current cash flow right now? It's about 8 grand. Holy, oh man, that's amazing. Okay, so now we got rid of all that, and so our current, the last thing we gotta do is pay off the mortgage. Okay, $510,000, and we just use that same method every time we have a super huge high balance loan with little monthly payments, and we can use that chunking method. And one of the things you might hear on the internet is, "Oh, go ahead and replace that mortgage with a high interest rate line of credit, even though you have a low interest rate mortgage." I've never seen that work out, right? So this whole chunking method thing is just an easy way for you to pay off your mortgage and have control over your money. Because when we make direct payments, extra payments into that mortgage, that money is gone, right? But this is just an easy alternative to help you do that and not segregate your income. Because segregation of income, even though it's mathematically okay, it's mathematically not, how do I explain this? Like easy to show the effects of it. It's a killer, right? It's a killer. So let's go ahead and do the same thing. So I'm going to go back to that velocity banking calculator sheet, and then we'll just, I guess you could see me fill it in. Sometimes I pause the video and fill it in so you don't have to watch me. But I know people like to watch me fill in everything and see, hey, you made a mistake. And I was like, dang, you're right. And I'm too lazy to edit it out. All right, so let's go ahead and fill out this number. So this is going to be now 3%, 30 years. And let me erase these. And I'll show you what I would do. So the the original balance is 510,000, and boy, 510,000. That's a pretty good home here in Georgia. It's like a huge mansion or a McMansion, right? And let me see. What is 4 point? Let me. Oh, I gotta do the loan calculator thing again. So 4.4 times 12. That's 50. We'll say 53 years or months. And then according to the calculator, looking at the other screen, the current balance is 468, okay, 0.19. And what is the, oh, did I screw up? Oh, I didn't do the 0.19. I did somehow put it 464.19. Okay, so now what's the payment amount? The payment amount is 2150.18. 2150.18. Okay. And then the living expenses is now just, I think it's just 3,500. No, 3,250. Okay, 3,250. And then we see here, wow, 4 years. 4 years. And so just kind of as a plug, where they get this from Renatus, and Renatus is where I originally learned velocity banking from back in 2017, right? And just as a side note, I actually, there's so, like, here's the thing, here's what people don't understand. Like, there's so much more to, I don't want to say life, but wealth building than velocity banking. Velocity banking is a tool in your toolbox, right? And there's other things you can do: buy properties at a discount, right? Not make rookie mistakes when it comes to buying properties. Possibly figure out the tax strategies to help you save money so that not all of your income goes to the tax man, right? That's where I learned a lot of this stuff from. So again, I actually resell their education, make some commission off of it. So if you're interested in, let's say, specifically getting this calculator, you gotta purchase the Renatus Essentials, right? So let me go back here, and I probably need to do a better job presenting it too, but I'll do that maybe when I'm not that lazy. Okay, so let me go ahead, and now we see that it's 4 years, so we'll switch screens here, and then yeah, so 4 years, this goes to 0, and now 8.4 years, okay, and then, so what's 350? So this is going to be 860K. All right, so in 8.4 years, we are completely debt free. Completely. You ever seen those videos where it's like, oh, pay off your mortgage in 7 to 10 years? Well, we paid it off in 4.4, right? 4.4 years, and it took us 8.4 years to pay off all of our debts, including the mortgage. Isn't that crazy? I don't know why people don't talk about this more. It's not just about paying off the mortgage, velocity banking. And if you're making this kind of money, and you're broke, I'm confused. You know what I mean? Like, you don't have to be broke. Listen, we're gonna take care of our broke nurses. And if you're a broke nurse right now, why don't you want to study with us? You got the money. You got the money. And if you could be debt free in under 9 years, wouldn't it be worth it? Especially if you're living paycheck to paycheck like this, right? And I'm actually helping at least one nurse with this concept. And then she was shocked. I can just look at her face where it's like, wait a minute, I own two houses and none of them paid off. And I told her, and I just kind of slip it in. It's like, oh, I paid off my mortgage in 3 years. I try to like like be a little bit sneaky about it. Just I don't rub it in their face, but just, oh yeah, look at this, I paid off in 3 years. What? And again, just because you make a lot of money, you're actually the bank's best demographic. You make a lot of money, but you're not, let's say, educated, and I don't like to use that word. Um, you're not, fluent in cash flow and debt management. We'll say it like that, right? Because just like with big pharma, the bank's best customer is not someone who's broke and poor. And it's not someone who's rich but can pay off debt quickly. It's someone who's rich but is kind of bad at managing their debt. Being rich and debt management have nothing to do with each other, right? Like, plenty of broke people out there who make plenty of money. And that's kind of like a myth in our society that um, only poor people are struggling with money. Rich people can struggle with money too, right? And so now we know that if you're a nurse and looking at this, that you don't have to be broke anymore. Okay. All right. Well, I don't mean to make fun, but it's. I remember when I first heard this about like a doctor who made over $500,000 a year and had to pack his own lunch because he was broke. I was like, I'm making only 20 grand a year, and I hate you. Right? But now that I'm a little bit older, yeah, and I don't want to say I'm a little bit wiser, but maybe I am. I kind of get it. Okay. All right. Well, that's it for today, everybody. This is Korean Atlanta Mentorship. Have a great day, and we'll speak next time.